Hello everybody, 25 and invested here, 26 and invested, soon to be 27 invested, blah 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 blah. Today we're talking about types of investing. Using my favorite sketch.io, I have drawn out the simple man's version, and I am a simple man, I'm an average person. I needed this explained to me the best way I could, and this is the best way that I could draw it as somebody who doesn't exactly know finance, but can explain it to somebody else because I've had it explained to me as simple as it could be. Dollar cost averaging is when you buy on an average basis. So you are not concerned about the highs and the lows. You're buying here, you're buying here, you're buying here, here, just everywhere. As you buy absolutely every chance that you can, not every chance you can, if you buy every month at the same date at the same time, then your average will be this red line. You move up the average of the stock market, and in this case the average has been 10%, whether it's been high, whether it's been low over the past however many years, over 50 years, the average has been about 9.9%. That's a pretty good average. That is the S&P 500, so that is not a managed fund. So SPY and VOO's average has been 10%. And if you invest every chance or on a very consistent basis all the way through, then your gain is going to be the average of what you bought. So in this case, 10%, whether it was high, whether it was low, you averaged that gain. Value investing, on the other hand, is something a little different. You want to buy basically here the entire time. When you believe that a company is undervalued, and a lot of people say that they can invest here very consistently. That is very hard to do. I know that some managers swear by this, and it is actually, very hard to do. Essentially, you're locking in a better rate of return. So in this case, our red line is the average of the stock market. Our purple line is the value investors' anticipated gain. And the reason why we use anticipated here is because you're trying to decide what an undervalued company is. These guys have a better chance of losing money. They have a better chance of misjudging a bottom. They have a better chance of misjudging a top. And it's just a style of investing that takes a lot more depth, a lot more work, and something that I am trying to do now and learn how to do. But that's personal opinion. As a matter of fact, a lot of these people who do value invest typically underperform dollar cost averaging. That's very, very common. And they're striving for maybe 12%, maybe 15%, maybe they're shooting for 20%, which is, I'd say, double the average. Might just be a little unrealistic. However, Warren Buffett, Peter Lynch, there's quite a few money managers that have consistently outperformed the market, and they do that through value investing. It's not as tried and true of a strategy as dollar cost averaging because of how consistent it is. Dollar cost averaging takes zero thought, zero work. You just buy a broad-based index fund every chance you get, especially here. Every chance you get, and voila. And I even kind of made this very crude drawing of the tech bubble. Essentially, it hit a large high, and let's say that you are an investor that got sucked into this. You would start your dollar cost averaging at the high. You would ride it down, and then it would take some time before you started to see yourself catching back up with the S&P. You would have lost a fair amount of money during this time, but dollar cost averaging over the long term has appreciated with the S&P. Whether you started at a high or whether you started at a low, there will be a time when your high that you bought will beat what you are now. Well, the high that you you bought it at will be lower than where you are now. And that just takes a lot of time. In this case, I kind of based this model off of Intel, and that took about 7 to 10 years. Cisco literally just broke the high of their 2008. They were one of the most susceptible companies for that because they were one of the most overvalued companies before that. In this case, I'm going to go ahead and say that this is going to be Tesla with a capital A. I don't know why, maybe capital L too. Yeah, so this is just the simple version of dollar cost averaging value investing. And you know, I could do this chart as a value investor, but a value investor is less likely to buy right here. So theirs would have started down here and then rode up, possibly a little better. Maybe they thought it was value here. Maybe they did buy the bottom and they have appreciated past where the dollar cost averager, but again, they did the research for it. They're not the average person. The average person underperforms the market, but the average person can outperform, or rather can perform the average of the market by dollar cost averaging. I'm trying to do a little bit of both, especially with dividend stocks. Not exactly a dividend investor, but you know, I'm trying to build a hybrid portfolio that borrows from the ideas of every portfolio. And I hope that you know, what I say is also representative to the way that my portfolio looks right now. Anyways, guys, I'll see you in the next one. Bye.